Today we analyse Rightmove to identify if it's good value at the moment and reveal whether this is the best stock opportunity in the FTSE 100. Rightmove's revenue has grown 24% in the last 5 years, with its growth slowing over time given its 10-year increase of 138%. That said, its unique business model has very high profit margins of 59%, and this has remained very consistent over the last 5 years. Profits have actually climbed by 163% in the last 10 years, but it has again slowed with only a growth of 22% in the last 5 years. Given that the market cap has only increased by 9% in this time, why aren't investors buying shares of Rightmove? Well, we need to evaluate the KPIs, particularly the dividend quality, to assess if shares are a value trap or defensive opportunity. On average, the dividend yield has floated between 1 to 1.1% over the last decade, with a current yield of 1.9%. This suggests that investors have recently been selling shares. Perhaps investors have become slightly more concerned about the sustainability of the dividend. Well, the EPS figures suggest that dividend growth is sustainable, with earnings per share growing by 32% and the dividend per share growing by 33% in the last 5 years. This has maintained a very attractive payout ratio of 35%, consistent historically. In fact, over the last decade, the dividend has seen a compound annual growth rate of 13.4%, a very respectable figure. When we contrast the dividend growth to the share price growth, we can see that the dividend has been growing at a faster pace, indicating that investors might have placed too much of a premium on shares based on earnings in the past. So does this mean that shares of Rightmove are overvalued and it's worth avoiding? Well, the price to earnings ratio is at 52-week lows of 19.6 times. This is still more expensive than the UK market average of 10.6 times. However, its historical averages are much higher, with its 5-year average at 33 times and its 10-year average at 32 times. If investors were to regain confidence in the business, then Rightmove shares could see quite an upside if it reverts to its historical mean. However, value investors will certainly be put off by the price to book ratio of 56.2 times, even if it appears undervalued compared to its historical averages. This could suggest that Rightmove has a depressed balance sheet, and so is Rightmove a risky investment? Well, the balance sheet has improved substantially from 5 years ago, with a growth in equity of over 440%, fueling the debt to equity ratio decrease from 104% to 14%. The current and quick ratios are both well above 2 times, showing good liquidity and defensiveness of the business's balance sheet. That said, the net book position is not driving shareholder value, as equity and cash have both fallen since 2020. This has driven the net book value down over 50% in this time. In the 2021 annual report, Rightmove stated that this fall in the net asset position was due to share buybacks and dividends. We can see that the total share count has reduced by 8% since 2018 and 18% since 2013. Given that Rightmove has consistently participated in share buybacks, it's likely that this suppresses the book value. But what has caused investors to panic and subsequently sell shares down to a 5-year low? To start, the half-year results show a picture of greater inefficiencies as they've seen revenue climb at 10% versus last year, but the profits have lagged and only grown by 1%. Profit margins have fallen by 11% in the last 2 years. When combined with the deterioration of the balance sheet since 2021, investors likely don't appreciate the short-term picture. This is worsened by the KPIs, which show that the increase in revenue is not from volume, aka growth of the number of the customers. Instead, it's driven by very chunky price increases. Interestingly, you could see this as both a positive and a negative. Customer numbers have remained consistent despite the price increases, really showing the dominant network effect of Rightmove. But this outlook is leaning towards the negative side, especially when considering mortgage rates are skyrocketing, which in turn impacts demand for the housing market as purchases become less affordable to be buying homes. That said, the agents' hands are tied, and they would still need to list these properties somewhere. However, there is one big risk that Rightmove faces that needs to be addressed. That is competition. Yes, I've spoken about the merits of the network effects in Rightmove, although recently a smaller competitor on the market was bought by a much larger group. They plan to spend over £46 million on sales and marketing in the first full year following the takeover, with a multi-year plan for further investment. This is triple the current media spend of Rightmove and could present a massive risk. So what does this mean for investors? Well, for investors, the competition is going to force Rightmove's hand. They dominate the market for now, but they will face the consequence of potentially shrinking margins, especially if on the market can pull away some of Rightmove's customer base. I think there's a chance that this fear is overstated and that Rightmove will be used in unison with on the market. However, this could be at a great cost to their profit margins, and this once defensive business could be in a tricky pinch. Based on a discounted cash flow valuation, I believe a fair price for shares to be around £3.71, and personally I would remain cautious around this stock unless I was an investor seeking a turnaround play. Perhaps Rightmove's margins being eroded by competition is a big concern to you. Do I know of a stock with huge competitive advantages? Well, yeah, click here to learn about a stock with an impenetrable moat.